How does foreclosure work with a FHA loan? Have you ever wondered what happens when a Federal Housing Administration loan goes into foreclosure? It's a process that can be quite different from other types of loans. Let's break it down so you can understand how it works and what it means for real estate investing. Foreclosure typically starts when a borrower misses mortgage payments for about 3 to 6 months. If payments are missed, the mortgage servicer usually charges late fees after about 10 to 15 days. However, if the borrower communicates early, there may be some short-term flexibility. Once the borrower is 30 days late, the loan is considered in default, and the foreclosure process speeds up. FHA guidelines requiring that servicers initiate foreclosure within 180 days, which is roughly 6 months, from the date of default. The process can vary depending on state law. Some states use non-judicial foreclosure, which means it does not go through the court system, while others requiring judicial foreclosure, which is court-supervised. This can affect how long the process takes and how complicated it is. One important aspect to consider is that FHA loans are government-insured. This means that servicers must follow specific loss mitigation policies to avoid foreclosure. They may offer options like loan modifications or repayment plans to help borrowers stay in their homes. If a property is foreclosed and conveyed to the FHA, the process to sell or dispose of that property can take a long time, often around 12 months or more. During this period, the home may remain as vacant, which can lead to increased maintenance costs and affect neighborhood property values. This is something real estate investors should keep in mind when looking at these properties. For investors, FHA foreclosures may take longer to reach auction or resale compared to conventional loans. Properties secured by FHA loans must meet certain habitability standards. This means that foreclosed homes may need repairs to meet FHA guidelines before they can be resold or refinanced. If you are considering purchasing a foreclosed home with an FHA loan, be aware that buyers using FHA financing must occupy the home as their primary residence within 60 days of closing. This can limit investor options unless they are buying with cash or conventional financing. Understanding the specific foreclosure laws and timelines in your state is also critical. These laws can influence how quickly a property becomes available for purchase and what rights borrowers may have during the process. In essence, foreclosure on an FHA loan starts after several missed payments and must follow federally mandated timelines. For real estate investors, FHA foreclosures can present unique opportunities, but they often involve longer timelines and specific property standards that can affect how these properties are acquired and used. Knowing these legal and regulatory aspects can help investors navigate the foreclosure market effectively.